Okay, well, it's now my great pleasure and honor to introduce our current AFA president, David Sharfstein, and invite him to give the 2018 presidential address. Let me say up front that giving this introduction is quite intimidating after the amazing job David did introducing Cam last year. So I have some pretty big shoes to fill. And if you've seen David's feet, you'll know I mean that literally as well as figuratively. David received his PhD from MIT in 1986. His first appointment was at HBS, and it seems MIT and HBS have fought over him more than once in the intervening years. It's easy to understand why. Here are just a few of the classics that David published shortly after receiving his PhD, which I'm sure will be familiar to you. Fruit, Scharfstein, and Stein, Journal of Finance, 1992, Heard on the Street, Informational Inefficiencies in a Market with Short-Term Speculation. Bolton and Sharfstein, AER 1990, A Theory of Predation Based Upon Agency Problems in Financial Contracting. Hoshi, Kashyap, and Sharfstein, QJE 1991, Corporate Structure, Liquidity, and Investment. Fruit, Scharfstein, and Stein, Journal of Finance, 1993, Risk Management, Coordinating Corporate Investment and Financing Policies. And Scharfstein and Stein, AER 1990, Herd Behavior and Investment. Again, these papers are all classics, highlighting themes that continue to engage researchers today. And indeed, over the past 5 years, David's work has averaged more than 2,000 citations per year. All told, he has over 40 publications with more than 30,000 total citations, a clear documentation of his enormous influence on the profession. He's been active in other ways as well. He's played an advisory role both at the New York Fed and the U.S. Treasury, helping to guide U.S. banking policy and regulation in the aftermath of the financial crisis. He's also a senior associate dean of doctoral programs at HBS, helping shape the next generation of financial economists. Now, all of these facts are, of course, well known, but it's a tradition for this introduction to try to go beyond the CV and try to provide some deeper insights into the making of David S. Sharfstein. Who is he really, and what is the secret to his success? Now, in doing my background research for this talk, I went to the usual suspects, colleagues, family, friends, students, scraping the internet. What I found is it's essentially impossible to dig up any dirt on this guy. Most of what I got back was, well, David's not really a risk taker. He can be funny, but mostly he's pretty earnest. Okay, so my job's not going to be easy. What do we know about David if we peer behind the curtain? What I learned is that we, as in our profession, had some near misses in the sense that we were very nearly denied David's talent. There were several alternative careers that he might have pursued instead of finance. He grew up in Brooklyn and apparently was a bona fide deadhead and might have instead pursued a career as a rock star. Indeed, that dream may still be alive, as David has apparently resumed playing guitar after a long hiatus. The other alternative reality that we could have seen is a sports hero. He almost became a sports star. Something you may not know about David is he was recruited to play on the Jewish Olympic basketball team in 2001. It was the over 40 team, but nonetheless, an incredible accomplishment. Now, I tried to find some documentation of this fact and was able to come up with this picture, and that's David right there. And again, you can tell by the feet. Okay. In addition, he also went on to have a stellar coaching career, leading the Angels to the Baseball World Championship in 2004. That was the Brookline Youth Baseball World Championships and his son's team. But for David, it was every bit as satisfying.
How excited were you?
So excited. I thought we'd actually won the real World Series.
But luckily for us, despite these near misses, these and other talents did not lure David away from his true calling to finance. So what's the secret to David's success? One thing that comes through in all the stories that I've heard about David is his perfectionism. He won't stop until he gets it right, and he won't let anything get in the way of that, including deadlines. We've all seen it in his research. His articles are incredibly careful and well-written. Apparently, this trait extends beyond his own research. For example, he once painstakingly scoured the New England countryside to find native plants in order to faithfully recreate the original garden of his home, which was built in 1882. He's equally demanding of his PhD students. Raghu Rajan, one of his first students, recalls trying to complete his job market paper. But every time they would meet, David would tell him he could not get beyond page 1 because the writing was so bad. Finally, with just weeks to go, David invited him to his office saying he had something for him. Excited that David might finally have read through his paper, instead, David handed him a copy of Strunk and White. Ultimately, after the 40th iteration, David did sign off on the paper, and in Raghu's dissertation dedication, he writes that if he's ever successful in publishing, he would owe it to David's incomprehension. He even holds high standards for his MBA students. He once had an MBA student, we'll call him Jim, who would constantly answer his cell phone in class. To teach him a lesson, David arranged to have his assistant call him in class one day, which he answered and said, "It's for you, Jim." Unfortunately, Jim had skipped class that day. Now, I've had the opportunity to see his dedication and perfectionism firsthand in his work as AFA president, writing and rewriting and re-rewriting the AFA Code of Ethics, revising and re-revising the new AFA website. But seriously, David is committed to get it right, and more importantly, is willing to put in 100% of the effort needed to do so, to all of our collective benefit. They say that timing is everything, and I feel especially lucky to be in this role following in David's very large footsteps. So with that, I introduce again David Sharfstein, our AFA president, and apparently very stable genius.
Well, thanks very much, Peter, and thanks to my family for outing me on some of these things. But it's a really terrific honor to be able to address the AFA, and I thank my family for being here, my wife, Sarah, my 2 daughters, Rebecca and Eliza, and my son, Ben. Thanks for making the trip here. And I also want to thank the many co-authors and colleagues I've had over the years, some of whom I've known for like close to 40 years now. You've really made this job fun. And I'm also grateful to the many people who helped me think about the issues that I want to talk about today. Without implicating them, I want to especially thank Will Diamond, Robin Greenwood, Sam Hansen, Gianluca Rinaldi, Jim Paturba, Jeremy Stein, Adi Sundaram. And I'd also like to thank Andy Wang for just tremendous research assistance. Thank you to all of them. Okay, so I'm going to talk about pension policy and the financial system. And I want to explore the idea that pension policy has had profound impacts on the financial systems of advanced economies around the world. In particular, I'm going to explore the idea that pension policy has affected the development of capital markets, which in turn has affected corporate finance, household finance, the banking sector, and the size of the financial sector. We all know that there's a lot of variation across countries in the structure of financial systems, in their reliance on bank funding, on corporate ownership, in household debt and financial assets, in the composition of bank balance sheets, and in the size of the financial sectors. And this year's new AFA fellow, Rob Vishney, and his co-authors have helped us understand some of what drives the diversity of corporate finance around the world. Christian Batarinza, John Campbell, and Tarun Ramadurai have recently written a paper that explores variation in household finance. And the World Bank has developed a data set that documents differences in banking structures around the world. Now, if you compared notes with your colleagues, many of whom likely come from different countries, you would discover that there's also tremendous variation in pension systems around the world, as countries have made vastly different choices about how to meet the retirement needs of their populations. For example, if you're an average Italian or Dane, you can retire at age about 67 and receive pension payments that approach 70% of your pre-retirement income, according to OECD estimates. In Italy, this retirement income would come from the government, largely, and would be financed in large part by taxes on current workers in what we would refer to as a pay-as-you-go pension system. It's like our Social Security system, only more generous. Now, in Denmark, a good deal of the pension payments, again, about 70% of your pre-retirement income, would come from payments made by private pension funds. And not surprisingly, the difference between how the Italian and the Dane gets paid is reflected in the amount of pension assets in the two countries. In Italy, private pension assets are under 10% of GDP. In Denmark, they're about 180% of GDP. Okay? So you can see that here. So in this figure, the countries shown here are all countries that joined the OECD prior to 1975. So I'm basically excluding the emerging market countries and formerly socialist countries which have evolving pension systems. And on the x-axis, I have the country's, quote, public pension replacement rate for the average worker in a country, as calculated by the OECD. This is how much of a worker's income is replaced by public pensions offered by the central governments. Okay? The private pension replacement rate is on the y-axis. Okay? This is how much income is replaced by private pensions for the average worker. Right? So in the US, those would be a combination of individual retirement accounts, employer-based defined contribution plans like 401ks or 403bs that many of you participate in, and defined benefit plans provided by employers where employers commit to a specific benefit and they have to fund that benefit in some way. Now, countries have different versions of schemes like these, and some mandate contributions to private pensions. Now, you should be able to find Italy and Denmark. Italy is in the southeast with a high public pension replacement rate of 70%, but very little from private pensions. Denmark's in the northwest. 50% comes from private sources and 20% comes from the government's public pension. Most of the other countries are in between Denmark and Italy, right? You can see that the US is pretty equally balanced between public and private pensions for the average worker. For many people in this room, the private pension would be a bigger piece of your retirement income, but for the average worker, it's about 50-50. Now, the next figure I'm showing, the public pension replacement rate on the x-axis again, and in fact, I'm going to show you a lot of pictures like this, where the x-axis is going to be this public pension replacement rate, and there's pension assets on the y-axis. Again, you can see Italy with its high public pension replacement rate, but not much assets, and Denmark with a relatively low public pension replacement rate. Now, I'm going to call the countries that are kind of in the southeast, the ones where most of the pension income comes from public pensions. Those are pay-go countries, pay-as-you-go countries. That's the public finance term for these countries. Okay, they're funding pensions with taxes on current workers on a pay-as-you-go basis. Okay, and the ones that are in the Northwest, we'll call those funded countries. Right, they rely much more on private pensions. The public retirement system doesn't provide as much. Now, let me quickly show you another picture that I will come back to. On the x-axis is, again, the public pension replacement rate, the replacement rate of the income, which, as we've seen, is related to being a country with a more pay-go pension scheme. Okay, on the y-axis is value added of the financial services industry relative to GDP. The value added is essentially profits plus compensation in an industry. And I'll call that finance value added relative to GDP. I'll call that the finance share. Okay, the finance share in the U.S. has increased a lot in the last 30 to 40 years. Robin Greenwood and I have linked the significant growth in the finance share in the U.S. to the growth in household credit and asset management fees. In any case, what this shows is a very strong negative relationship between the public pension replacement rate, how much public funding there is, how pay-go a country is, and the finance share. In countries with generous public pension systems, the financial system, the financial sector is much smaller. The finance share is much smaller. It's about 5% of GDP. And where public pensions are not very generous, where the private pension system is bigger, the finance share is more like 8% of GDP. So there's clearly a relationship between pension policy and the size of the financial sector. And I want to explore what might be driving this relationship, but principally what might be different about the financial sectors of countries with more pay-go-oriented pension systems rather than these funded private systems. Okay, so as I mentioned, I want to explore the hypothesis that by encouraging the accumulation of private pension assets, countries have indirectly promoted the development of capital markets. And I want to explore the impact on financial systems in corporate finance, in household finance, and in banking. And in my corporate finance analysis, I'm going to explore the implications for bank versus bond financing, firm size, and ownership structure. In the household finance piece, I'll explore the implications for household asset composition, including housing, and I'll look at the implications for household leverage. And in banking, I'm going to look at the composition of bank balance sheets. And I'll spend some time looking at the implications for the size of the financial sector. And finally, I'm going to talk about what implications it might have for financial stability. So I'm going to start with some theory, and then I'll move on to the empirical analysis, which will basically involve showing you a series of scatter plots like the one I just showed you. Right? The paper's going to report regression results with controls, such as GDP per capita and at times legal origins. So you guys you've graduated to being a control. You're so well established in your fields. Okay, but they don't affect the conclusion. So I'm just going to show you the more visually appealing scatter plots. Now, if you're looking for empirical analysis with a clever identification strategy, you are in the wrong place. You have to go to the Liberty Bell room over at the Marriott. That's not to say that I'm not going to think about alternative explanations of my empirical findings. Okay, I'm going to discuss some of them towards the end of the talk. But I want to be clear from the outset that for the most part, I'm working with 23 observations. So I've clearly not jumped on the big data bandwagon here. But relative to next year, I'm guessing I got a lot of data points. So I'm using this opportunity to explore an idea, and I hope there'll be more work that will come up with clever ways to test some of the ideas I'm going to present here. Now, before I describe the theory, I want to note that a key assumption of my model and the interpretation of the empirical findings is that private pensions add to household savings relative to a public pay-go scheme. Now, pay-go schemes are thought to discover private savings because if you know a Social Security system is going to give you a retirement income, you don't really need to save. Now, a question is whether encouraging private pensions, say through tax subsidies, as we do here in the U.S., adds to household savings, or just encourages people to move savings from accounts that are not tax-favored into more tax-favored pension accounts. There's some of this going on, but research and Jim Paterba and co-authors conclude that it's unlikely to be one-for-one, so that private pension savings do add to net savings. I think there's an effect. There's a question about what the magnitude of the effect is, but it's an assumption in my work and in the model that there is an effect of pensions on savings. Now, at the bottom of the page, what you see is a graph of financial assets over GDP on the public pension replacement rate. So again, it's to the right of the graph. As you move to the east, that's a more pay-go public pension system. And countries with more generous public pension, more generous public pensions have lower levels of financial assets relative to GDP, consistent with public pensions crowding out private savings. Indeed, most of the difference in financial assets between these pay-go and funded countries comes from differences in pension assets of households in the two sets of countries. Okay, so now let me turn to the theory. Okay, so the goal of my theoretical model is to develop some predictions about how pension savings could affect key choices of households, firms, and banks, and whether it affects the structure of the financial system, whether it's more bank-based or capital markets oriented. So for that, for my starting point, is a theory based on Will Diamond's model of financial intermediation, which he embeds in a general equilibrium model of an endowment economy. In his model, banks want to issue deposits to meet household demand for safe, money-like assets, which he models by putting money or safe assets in a utility function. This idea appears in work by Gorton and Pinocchi, and there's been a recent flurry of interest in models that build off this idea, including work by my colleagues Robin Greenwood, Sam Hansen, Jeremy Stein, and many others. In Will's model, in order to issue safe deposits, banks could hold risky assets and then issue a lot of equity to make sure that those deposits were safe. But issuing equity is costly because of financial friction. So instead, banks want to hold relatively safe assets combined with a relatively thin equity cushion. And the cost of equity is grounded in an agency model. And what emerges is a segmentation of risk between banks and markets. Banks hold the relatively safe assets, and households hold the risky assets. This also implies different discount rates for banks and households, and Will goes on to derive implications for the capital structure of non-financial firms, which try to meet investor demand for safe and risky assets. And he examines the effect on quantitative easing and other policy measures. Now note that this safety money creation view of the role of banks is very different conception of banking than you see in a lot of banking research, which emphasizes monitoring and screening of the role of banks. They're not really at odds with each other, and both could be part of what's going on. Indeed, there's another Diamond who has written about the monitoring and liquidity creation view of banking. But the money creation perspective, I think, has some appeal because a lot of bank assets, like mortgages, credit card receivables, are not really very monitoring intensive. In any case, Will's model of banks is useful for me for this application. I think it could be useful in a number of other applications. So I'm going to embed his basic model of banks, okay, in a quite different model of the economy. Okay, so what am I going to assume? So here are the assumptions I'm going to make. I'm not going to go introduce a lot of notation. This is not the place for that, and drag you through a bunch of equations. I'm just going to describe the ideas. Okay, so in the model, savings are exogenous and randomly distributed within the economy, but there's a greater average savings in economies with funded private pensions. And in this setup, the average savings in an economy, which moves with this parameter alpha, indexes the extent to which an economy uses funded private pensions. Households have to hold a minimum amount of deposits, M star, and this is a very simple way to introduce a demand for money-like safe claims. And I'm going to model a production economy, which enables me to derive implications for the effect of pension savings on aggregate risk-taking in the economy. There's a low-risk project and a high-risk project, and both are in infinite supply. The high-risk project has higher expected payoffs, and there are two aggregate states of the economy, good and bad, and these are the only sources of risk in the economy. Now, I make the critical assumption that there are fixed costs, K, for households to invest in capital markets. This means that households with a lot of savings are going to be more likely to invest in capital markets. And I'll later extend the model to include mortgage financing and cost of asset management. But for now, I'm going to work with these assumptions and get some straightforward conclusions. Because of the fixed cost of investing in the capital market, as I mentioned, households only invest their savings if they have, in the capital market, if they have savings above some threshold. If they're not above this threshold, they put all their savings in bank deposits, actually more than this minimum M star. As a result, in high pension savings economies, more households want to invest in the capital market, and they put less of their savings in bank deposits. This gives us the first result. In high pension savings economies, since more investment activity goes through the capital market rather than banks, more of these high-risk, high-value projects are taken. Right? Banks only want to do the relatively safe projects. So in high savings economies, you get high value, high risk projects. The interpretation is that countries with more private pension funding will be more capital markets oriented. And PAYGO countries will be more bank centered. Okay, so that comes directly out of, it's a combination of the model of banks plus the assumption that in high savings economies, there are more investors that want to invest in the capital market. Okay, so I'm going to look at, as I mentioned, the implication for bank dependence of firms, the size of firms, and inside ownership. And here's a picture that just plots bank loan share of corporate debt, so what fraction of bank loans, what fraction of corporate debt comes from bank loans. We're predicting a positive relationship between that and the public pension replacement rate. And this is what you see, right? You see that there's this positive relationship. So firms in more PAYGO-oriented countries borrow more from banks. The next implication is that firms should be smaller in more PAYGO countries. This follows in part from their bank dependence, since banks want to limit risk for reasons that we've talked about, right? They want to ensure they can issue safe deposits. Thus, banks are less likely to want to fund the kinds of projects that result in very high payoffs and potentially large firms. There's some evidence for this view in other research. For example, Weinstein and AFA show that banks in Japan limited the growth of their client firms, and that when bond markets were deregulated, it stimulated growth. Okay, so this is plotting firm size. I'm going to plot firm size on the next two slides. Here I've plotted the share of employment in firms with 1 to 9 workers. You can see that the share is much higher in countries with more generous public pensions, right, in the PAYGO countries. And the flip side of this is also that you see a smaller employment share in the largest firms, in 250 plus employees in the PAYGO countries. Now let me look at the implications for inside ownership. I think it's a relatively straightforward implication, is that in countries with more funded private pensions, there will be more demand for corporate equity, and insiders will have greater incentives to sell. Okay? Indeed, you see a very close connection between inside ownership and public pensions. There's much more inside ownership in PAYGO countries. And again, this is robust to obvious controls, including industry and size, GDP per capita, legal origins, and so on. Now, there's obviously more work to do here to tease out causality. One approach would be to examine the effect of pension policy changes on corporate financing behavior. A nice example of this is a paper done years ago by my colleague Josh Lerner and his co-author Sam Cordham. They looked at the effect of ERISA law changes in 1979 that allowed pension funds to invest in venture capital. And they found that it led to more venture capital fundraising and had positive effects on innovation. There'll be some more significant pension reforms in the future as countries deal with the fiscal burden of PAYGO pension schemes, and so this could be an opportunity to help tease out causality. Okay, now I'd like to explore the connection between pension policy and household finance. My focus is going to be on housing and mortgages because of the importance of housing in household wealth and the importance of mortgages on the balance sheets of financial institutions and households. To start, I'm going to discuss the extension of the model to include home ownership and mortgages, and then I'm going to move on to discuss some of the empirical facts. Okay, so I'm going to extend the model with the following sets of assumptions. Okay, everyone has to own a house, H units of housing. Think of housing as low risk, so it can be used to back the issuance of safe deposits. We assume the financial returns on housing equity are lower than the returns on capital market investments. And that's because when you own a house, you also get the dividend rental income from living in the house. Now, as before, households can hold deposits and capital market investments, but now they can also own housing equity. Now everyone's going to hold a minimum amount of deposits, M star, just to meet their liquidity needs. Low savers are going to put the rest of their savings in housing equity, right? Because they don't want to pay the fixed cost of going in the capital market. And high savers are going to borrow. They're going to sell off, effectively in the model, sell off the equity in the house so that they can invest as much as possible in the capital market, which has higher financial returns than housing equity. Okay. Now, from this extension, you get a few empirical predictions, and I'll go through each and show you the data. Okay, the first is that the loan-to-value ratios should be higher in countries with lots of private pension savings, less in countries with more pay-go-oriented pension systems. Where saving is high, there are more households who are willing to pay the fixed cost of investing in the capital market and don't want to hold much housing equity. Where savings are low, not many households want to pay the fixed cost of investing in the capital market and therefore invest more in housing equity. Denmark has very high leverage ratios for their households and very high pension savings. Okay, Italy, low, and a lot of housing equity. Okay, you're going to see that here in the plot. Okay, more funded countries have higher LTVs. More pay-go countries have lower LTVs, loan-to-value ratios, on housing. Now, note that the model assumes the value of housing assets are the same across countries. Now, you can see that there's variation in the value of housing relative to GDP. So I'm plotting value of housing assets relative to GDP, but it doesn't vary systematically with pension policy, right? So you might have been concerned that there are higher LTVs in countries with more private pension savings because people need to borrow more to purchase more expensive homes. But that does not really appear to be the case. Okay, finally, it follows that given LTVs are higher and house values are no different in funded countries, that household debt to GDP is greater in funded countries, in countries with private pensions, as you see in this slide. Now, I'm going to come back to this point later when I discuss the broader financial stability implications of pension policy. Now let's look at the implications for financial assets. Okay, as I explained, the model implies that households, whether high or low savers, put the minimum amount in deposits to meet their needs for safety and liquidity. Everything else goes into housing equity or the capital market. So deposits to GDP should not vary systematically with pension policy, and indeed it doesn't. Again, there's variability, but there's no systematic relationship with pension policy. By contrast, in funded countries, deposits as a share of financial assets should be lower. And that's really just because financial assets should be higher when there's more pension savings. And that's what you see. So deposits as a share of financial assets greater in the pay-go countries, lower in the funded countries. And this is really a consequence of the fact that financial assets relative to GDP are higher in the funded countries, lower in the pay-go countries. Now, the combination of facts that I've shown you also just imply that housing equity as a share of household assets is higher in pay-go countries, which you see on this graph here. Now, finally, the theory has implications for the composition of bank balance sheets. Because housing-related assets are relatively low risk, they're good for banks to hold on their balance sheet. And because there's more mortgage financing in funded countries, what it does is it crowds out bank investment in other low-risk projects. Okay, the result is that household credit as a share of all bank loans is greater in funded countries than in pay-go countries. This is a smaller sample. We had a smaller sample of countries for which we could get bank balance sheet composition. But you see that in the pay-go countries, you see less mortgage debt on their balance sheets, and in the funded countries, more. I'm going to return, as I said, to household finance in a bit when I discuss implications for financial stability. Now I'm going to turn to another important issue, which is how pension policy affects the financial sector and might lead to a deepening of capital markets in a way that I'm going to make more precise shortly. And to examine this question, let's suppose that households want to invest in that households hire a pension fund manager to invest in the capital market. They pay a fee of F per unit of assets under management. Fees lower capital market investment because it lowers the net return to capital market investments, and it will increase bank lending relative to an economy in which there are no fees. Now let's suppose there's a fixed cost of asset management, call that capital F. The zero profit condition, let's just assume that for simplicity, implies that the asset management fee is just given by F times the expected capital market investment output, equaling the fixed cost of running an asset management firm. And so the fee, little f, is decreasing in capital market investment. The more capital market investment you have, the lower is the fee. Now, you can get multiple equilibria, right? You can get an equilibrium in which one equilibrium is which the capital market is small and fees have to be high to cover fixed costs. And given that fees are high, investors or savers don't want to put their money in the capital market. But you can also have an equilibrium with a large capital market and low fees, in which households are encouraged to invest in the capital market. But the more interesting implication for my purpose is that these effects can lead to a kind of capital market deepening, by which I mean it brings people into the capital market who would not have participated. When there are fixed costs of asset management, economies with more pension savings will have lower fees. In other words, take two households, one led by Magnus, the other by Maria, with identical savings. Magnus lives in Denmark, where others are saving a lot because of the pension policy, and Maria lives in Italy, where there isn't as much pension savings. Now, fees ought to be low in Denmark, according to this theory, and high in Italy. But that means Magnus, who is no different from Maria in terms of her savings, will be more likely to invest in the capital market. I'll refer to this as capital market deepening. More households are brought into the capital markets because high pension savings bring down fees. It also means that there's an amplification mechanism whereby an increase in pension savings leads to a reduction in fees, which then brings more households into the capital market. More high-value investment is taken, and fees are lowered further. You end up in a kind of virtuous circle. And you also get an implication that capital market deepening will increase the size of the financial sector. Now, I can't really test this idea, but I want to go back to a slide I showed you at the beginning of the talk to take a closer look at the link between pension policy and the size of the financial sector. Okay? So this is, again, a graph of the finance share on the public pension replacement rate. And what you see is that it's decreasing in the extent to which the public pension systems are more generous. Remember, on the x-axis is the variable we've been looking at, it's the public pension replacement rate. On the y-axis is the finance value added as a share of GDP, what I'm calling the finance share. And remember that value added is just profits plus compensation, and what you see is this striking negative relationship. Okay, now let's look at a slightly different version of this, which is rather than graphing public pension replacement rate on the x-axis, I'm going to graph pension assets relative to GDP. Right? So as you go to the east, as you go to the right on this graph, what you see is that you're getting more to a funded country, and then the left is more pay-go, right? So Italy is on the left, Denmark is on the right. Now let's look at the magnitude of this relationship. Okay, the slope of the line is 1.9%, implying that for each dollar increase in pension assets, finance share goes up by 1.9 cents. Now, you might be concerned that like just the relationship between finance share and pension assets is just purely driven by asset management fees, right? You got more pension assets to manage, the financial sector is just going to get bigger. But I don't think that's the whole story. And to see why, note that the value added in the securities industry is about 50% of revenues. So profits plus compensation is about 50% of revenues. The rest is going to go to equipment, real estate, electricity, and so on. But that means in order to get a 1.9% increase in value added, we would need fees to be 3.8% of assets under management. And that seems like an implausibly high number. 10 years ago, Ken French stood here and presented his presidential address and said that the number was about 75 basis points in the US. Now, it's true that asset management fees tend to be greater outside the US, but not 5 times greater. Say they're twice as high. That's 150 basis points of revenue, which is the equivalent of 75 basis points of value added. So that leaves another 100, 115 basis points of value added to explain, possibly more if I've overestimated asset management fees. Now, it could come from the supply side of assets, underwriting, origination, which Thomas Philippon has analyzed as part of his work on the cost of intermediation in the US over time. And it could be valuable to try to use the international data to examine the issues he addresses. But some portion of the finance share that is unexplained by asset management could reflect capital market deepening, whereby pension savings stimulates more capital markets participation and a larger financial sector. But I admit it's hard to say. Now, I've described the relationship between the financial system and pension policy and have given a very causal interpretation. That pension policy drives corporate finance and household finance outcomes as well as the size of the financial sector. But there are clearly alternative explanations. I've listed a few of them here, okay? One possibility is that pension variables proxy for legal origins, namely that, as LSV demonstrate, financial markets are more developed in countries with legal systems that derive from English common laws compared to legal systems that are based on civil law, such as in France and Scandinavia and continental Europe. Turns out that civil law countries do, on average, have more generous public pensions, and they have smaller financial systems. But this doesn't really explain the results. Okay, I think you can see this pretty clearly in the figures on the next slide, which plot finance share on public pension replacement rates for civil law countries on the left and the less common law countries on the right. Okay, there's significant variation in pension systems within both types of legal systems. And the structure of the pension system has a large effect on finance share within a given legal system. It's fairly safe to conclude that there is a relationship between financial sector size and pension policy, independent of any effects of the legal system may have on the financial sector. And you can see that legal origins matter as well. Like the line is shifted up for common law countries relative to civil law countries. And my regressions all, as I mentioned, control for this, and you basically see that both of these things matter. Now, the other alternative explanations have to do with the endogeneity of pension policy, right? For example, you could argue with that where trust is low, financial markets are not well developed, and policymakers don't want to rely on financial markets for pensions. or that countries that experience more wealth destruction through war or hyperinflation are less confident in financial markets and therefore put in place policies that are more restrictive of financial markets. Parati and Schweinbacher have made this point. And then including relying on more pay-as-you-go pension policies. Or there could be some reverse causality, right, whereby policymakers choose pay-go systems because financial markets are not well developed. Now, I've looked into these explanations, and I think there's elements of truth in them, but I don't think they're the whole story. The paper has some detailed discussion and empirical analysis of each of these hypotheses. I think our best hope going forward, teasing out causality, again, as I mentioned before, is to look at policy changes. Now, I want to conclude by spending some time talking about the potential implications of my findings for financial stability. Okay, one stream of the public economics literature on pensions examines the distributional and risk-sharing implications of various pension systems. I'm not going to describe that literature other than to note that Peter Diamond has written about this topic, including a general equilibrium model with John Giannakopoulos that looks at the implications of pension policy for risk premia and interest rates. For those of you who are not keeping score, you should note that I've now referenced 3 separate Diamonds in this talk. The model and empirical work I have presented, though, point to other ways in which the pension system could affect risk in an economy through indirect effects on the financial system. One particular mechanism could operate through mortgage credit. Oscar Jorda, Morton Scholarik, and Alan Taylor present evidence that mortgage credit is central to many financial crises, and banks have increased their exposure to real estate over time. Adverse shocks to real estate thus impair the banking system and its ability to extend credit. Excessive mortgage credit could also lead to excessive volatility in consumption and amplify business cycles, as Atif Mian and Amr Soufi have documented in the US, and Mian Soufi and Emil Werner have looked at a broader set of countries over a longer period. And because households in countries with funded pension systems take on more mortgage debt, and banks are more exposed to mortgage credit in those countries, it's possible that an unintended consequence of funded pension systems is to make countries more vulnerable to business cycles and financial crises. The findings here also relate to the debate around the costs and benefits of market-based or bank-based financial system, to the extent that pension policy pushes a financial systems towards one form of finance over another. This is not the place for a full analysis of the two systems, so I will simply point out that they have different implications for financial and economic stability, monetary policy, bank regulation, and the cost of credit, with neither clearly dominating the other. For example, a market-based system may involve less stable funding, as Gordon and Metrick have pointed out, which exacerbates the effect of a financial crisis, but at the same time, it may enable non-financial firms that are cut off from loans when bank credit supply is tight to get bond financing in the capital market. It's a point made by a number of authors, including Becker and Vashna, in the context of the financial crisis. The point here is that pension policies have broad implications for the economy, for the financial system, and they can't be evaluated with a single objective in mind, such as reducing labor market distortions. The paper adds other potential considerations to the policy mix, the effects of pension policy on household leverage and the knock-on effects for financial and economic stability. Whether and how we can add these sorts of considerations to an already complex set of economic and political issues is not easily answered. I hope that this talk has gotten you interested in the role that pension policy could play in financial systems around the world. I think there's a lot more work to do, both in the development of the theory and in the empirical facts. And I hope some of you will engage with the issues that I've discussed. Thank you for taking the time to be here and to listen to what I have to say.
Thanks again, David, for your very insightful talk and your tremendous service as AFA president. I have this plaque for you as a token of our appreciation. Thank you very much.
Thank you. And with that, I think I'm supposed to hand this over to Peter, who will adjourn the meeting, right?
Okay, well, that concludes our meeting for tonight, and we've got a reception down the escalator in Millennium Hall, so look forward to seeing you all there.